Hello, and welcome to myfinanceteacher.org. SD3000, thanks for suggesting to have a look at Artemis Gold. And this is what we're going to do now. This is a developer. Usually we look at producing gold miners. So the risks with developers are higher. Keep that in mind, which means that even though valuations look really attractive, there are also risks if things don't go well with the project. So with that out of the way, as usual, let's have a look at discounted per share value of the reserves and resources in the ground after debts and production costs. Of course, we're going to have a look at three scenarios for gold and silver prices: balanced, conservative, and optimistic. Balanced price for gold is $1,752. For silver, that's $22.2. Conservative gold price is going to be $1,577 and $20 for silver, and optimistic price is going to be $1,927 for gold and $24.50 for silver. Artemis reports in their November 2020 Blackwater technical presentation that they have 8 million ounces of proven and probable reserves of gold and 72 million ounces of proven and probable reserves of silver. In the same presentation, they show inclusive measured and indicated resources. Inclusive means that the numbers include the proven and probable reserves. In my analysis, I do look at the exclusive M&A resources. So subtracting the proven and probable reserves gives me 1.4 million ounces of measured and indicated resources. That's at 0.4 grams per ton of a cutoff. There are different cutoff levels depending on how efficient the extraction is going to be. This 1.4 million ounces of measured and indicated resources is around the midpoint expectation, maybe just a step closer to the optimistic expectation. Same for silver. Exclusive measured and indicated resources are 19.1 million ounces. For all-in sustaining costs, Artemis reports $616 per ounce, but the costs rise as the project matures over the years towards the $800 per ounce. Let's be a little bit conservative and let's just plug this $800 per ounce of all-in sustaining costs. They don't report the all-in sustaining costs for silver, so I'm just going to take a gold-silver ratio of 80. The sources for the gold costs is the same presentation. Currently, the company doesn't have much long-term debts, only just over $500,000. But development of the project will expect a further capital expenditure of around $634 million over the first few years of the project. And I'm going to include that as the company's debts. And the source of these numbers is that same presentation, as well as the financials report for Q3 2020. The company has 162 million shares outstanding that are fully diluted, as reported in that same November 2020 presentation. Unlike many other producing miners that we look at, the company has a huge percentage of shares owned by the insiders. In this case, though, I'm not going to include this into the calculation as the risks with the developer are high, and it's only natural for managers to hold a relatively large percentage of the shares. As usual, I'm going to apply an annual discount rate of 5% to the mine life of 23 years. All of that gives us a conservative valuation, which includes the gold price of $15.77 and a silver price of $20, and only looks at the proven and probable reserves of $30.39, which looks very attractive compared to the market price of only $4.16. But remember, this is not a producing mine. This is a developer. So there are still higher risks associated with a range of things that might happen before the mine actually starts producing gold. Before we continue, let me remind you guys to subscribe to the channel if you haven't, and click that bell notification. Thanks a lot. Next, in our balance scenario, we include the price of $17.52 for gold, $22.2 for silver, and again, we only look at the proven and probable reserves, in which case we get a balanced valuation of $37.94. Again, very attractive compared to the market price of only $4.16. And lastly, in the optimistic scenario, again, we're going to look at $19.27 for gold price, $24.5 for silver price, and in addition to proven and probable reserves, we're going to add half of measured and indicated resources mentioned above. All of this gives us an optimistic valuation of over $49, which is more than a 10-bagger in this case. But again, remember, none of this is guaranteed, especially with a mine that doesn't produce anything yet. On the positive side, though, there are further interesting highlights. As I mentioned, management owns a big percentage of the shares. In this case, it's 42% of shares. That is a very good sign. And the management has some experience with other projects, such as Atlantic Gold, which increased the share price by over 1,100% during the development of that gold mine between 2014 and 2019. So although on one hand this mine is not producing anything yet, and we should be aware of the risks when looking at this very attractive balanced valuation of nearly a 10-bagger. On the other hand, the management does seem to have an experience of creating those 10-baggers. So let's hope the development over the next few years goes well, and maybe in addition to what the mine is shown to have already, further exploration potential might actually improve the reserves that the company has. For more analysis on gold miners as well as a range of other assets, join us at myfinancesteacher.org. You can do that by clicking this register button on the homepage. For now, I wish you a nice day and good luck in your trades.